Consumer confidence is one of those numbers that looks reassuring until you ask what it is actually measuring. A headline says confidence rose, and the immediate assumption is that people must be feeling better about the economy. Maybe households are less anxious. Maybe spending will stay strong. Maybe the labor market still feels healthy enough to support growth. But sometimes confidence numbers create a cleaner story than the economy itself deserves. And right now, that seems to be exactly the problem. Because even though consumer confidence ticked up in March, job openings fell to 6.882 million in February, and hiring dropped to 4.849 million, the lowest level since the pandemic period. That creates a very awkward contradiction. The headline looks fine, but the hiring side of the labor market looks much weaker than it should if consumers were truly standing on solid ground. That contradiction matters because confidence is not the same thing as strength. Confidence can rise for all kinds of reasons. Sometimes people are reacting to financial markets. Sometimes they are reacting to politics. Sometimes they are simply responding to the absence of immediate panic. But the labor market is different. Hiring and job openings tell you whether businesses are actually expanding, actually adding capacity, and actually willing to spend money on labor. And when those numbers weaken sharply, it changes the meaning of a confidence rebound. It suggests the public mood may be holding up better than the underlying engine. That is what makes this topic so interesting. On paper, a rise in consumer confidence sounds like good news. But if hiring is falling hard at the same time, then what you may be seeing is not real strength so much as a lag between sentiment and reality. People may not fully feel the weakness yet, or they may still be answering surveys based on broad impressions, while the labor market underneath them is already losing momentum. Either way, the result is the same. The surface looks stable, but the structure underneath looks less convincing. To understand why this happens, you have to separate how people feel from how businesses behave. Consumers answer confidence surveys based on expectations, personal finances, headlines, prices, politics, and how secure they think the world feels around them. Businesses make hiring decisions based on costs, margins, demand, financing conditions, and what they expect to happen next. Those two things can move together, but they do not always move together. And when they split apart, the labor market usually tells you more about where the economy is actually going. That is especially true now, because hiring is not just slowing a little. The hiring number matters because it reflects how willing companies are to commit to growth. A company can avoid layoffs and still behave defensively. It can freeze hiring, delay expansion, stop replacing workers, and become more cautious without creating the kind of dramatic headlines that layoffs create. That's how labor markets soften quietly. Not with a collapse, but with hesitation. Not with a giant firing wave, but with fewer opportunities, fewer openings, and less willingness to add people. This is why a weak labor market number can be more important than a decent confidence headline. Confidence can drift higher, even if the economy is becoming less dynamic. But when hiring falls sharply, it often means businesses aren't seeing enough clarity or enough demand to justify growth. That matters because jobs are one of the strongest links between the broader economy and household spending. If businesses become more hesitant to hire, eventually that affects income growth, job switching, negotiating power, and consumer behavior. And that job switching point is especially important. A healthy labor market is not just about people keeping their jobs. It's also about people being confident enough to leave one job for a better one, and companies being willing enough to create new roles. When hiring falls and openings shrink, the labor market becomes static. People feel less comfortable taking risks. Workers stay where they are. Employers become more selective, and the economy starts to lose some of the energy that makes expansion feel broad-based. That is one reason consumer confidence can start to feel fake, or at least misleading. Because if the labor market is shifting from a high mobility environment into a low hire environment, then confidence may be capturing a mood that is already starting to age out. People might still say they feel okay, but the economy may be giving them fewer reasons to feel okay going forward. The comfort becomes backward-looking. The risk becomes forward-looking. There's also another layer to this story, and that is inflation. Consumers may say they feel somewhat better in one survey, but if they are simultaneously expecting higher inflation or facing renewed price pressure from energy and essentials, that confidence becomes more fragile. Confidence is much easier to maintain when the labor market is strong enough to offset rising prices. But if hiring weakens while price pressures remain uncomfortable, households can end up in a strange middle ground. They're not in full panic, but they're also not genuinely secure. They're simply trying to hold their position. That kind of environment can create misleading signals in the data. Spending may still look decent for a while, but it can become more selective. Confidence may hold up in headline form, but underneath that, caution spreads. Businesses may not be firing aggressively, but they're also not building. And that low fire, low hire setup can look stable right until it starts weighing more obviously on growth. This is why economists care so much about job openings and hiring. Job openings tell you how much labor demand is still out there. Hiring tells you whether that demand is actually turning into jobs. If both weaken, then the labor market is losing momentum. And once labor market momentum fades, it usually takes time for the public to feel the full implications. That's why confidence can remain better than the underlying trend for a while. People don't instantly update their economic mood every time labor demand softens, but businesses usually move first.
Another reason the confidence number feels less convincing is that confidence itself is highly sensitive to framing. A small rise after a weak period can sound stronger than it really is. It can create the impression of resilience even if the level remains mediocre. Meanwhile, labor market deterioration is often harder to package dramatically, especially when it shows up through fewer openings or slower hiring rather than a big unemployment spike. So you can end up with a headline economy that sounds better than the real economy underneath. And that difference matters because policymakers and markets both care about whether the consumer can keep carrying the economy. If confidence is genuinely strong and the labor market remains healthy, then spending can continue supporting growth. But if confidence is mostly headline deep while hiring and openings weaken, then consumer strength may be more fragile than it appears. That changes how people think about growth, business investment, and even monetary policy. It also changes how we should read the phrase consumer confidence. A rise in confidence does not always mean households are truly optimistic in a durable way. Sometimes it just means they are slightly less negative than before. Sometimes it means the survey is capturing sentiment before the labor market weakness fully sinks in. And sometimes it means people are answering one set of questions while the real pressure is building somewhere else. In this case, the somewhere else looks a lot like the hiring market. That is what makes the contradiction so revealing. If consumers are supposedly more confident but employers are posting fewer openings and bringing in fewer workers, then one side of the economy may not believe the upbeat headline. And when households and businesses stop moving in the same direction, it usually means the cleaner story is not the more accurate one. In the end, consumer confidence still feels fake not because the number is fabricated, but because it may be describing a mood that is less solid than it appears. The headline says people feel somewhat better. The labor market says businesses are acting more cautious. And when those two things collide, the labor market usually deserves more attention. Because confidence can wobble and recover quickly, hiring decisions are where caution becomes real.